I think they are illustrating or the Bitcoin treasuries, they are illustrating that at least in the treasury market, for whatever reasons people choose to buy MicroStrategy, maybe it now is offering a yield curve with it.
She also highlights the growing role of Bitcoin treasuries and ETFs, particularly how companies like MicroStrategy have essentially created a Bitcoin yield curve through debt strategies tied to BTC. In her view, these are winner-take-most opportunities. The firms that move the fastest and most aggressively toward crypto adoption will likely secure the lion's share of benefits. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comment section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.
We have not bought a Bitcoin DAT, so I should be clear there. But Ether, yes. Solana, yes. Staking's a big answer to that question. In terms of the Bitcoin ETFs, I think they are illustrating or the Bitcoin treasuries, they are illustrating that at least in the treasury market, for whatever reasons people choose to buy MicroStrategy, maybe it now is offering a yield curve with its debt strategy for Bitcoin. So that's kind of interesting. But these are winner-take-most opportunities. We think that the companies that allocate assets to these new instruments, that the one that moves the fastest, the most aggressively, is probably going to win the lion's share. Maybe it's geographic. I know Metaplanet in Japan has done well, but MicroStrategy is king of the hill, obviously, here in the United States.
Cathie, I want to focus in on two of your funds, the ARK Innovation ETF and ARK-F, because there's been some really interesting trading over the past month or so, specifically around IPOs. I look at ARK-K, for example, ahead of the Klarna IPO. You saw your fund AUM balloon by $3.5 billion, a real surge in share creations, which were then redeemed in the days that followed. It's been theorized that this is basically a way for whoever's behind the trade to get exposure to shares of the IPO in a sort of roundabout way. And I know you've addressed this before, but does ARK know who is behind these huge trades?
No, we don't. But we do think, as you say, Katie, that they are solely, the surges are solely to get into whatever the IPO is. Now, what happened is Circle, we were a cornerstone investor, $150 million, and you saw what happened to that stock. Saw no such activity around that particular IPO. However, it seemed to give, I'm going to say, market makers and others the idea that, wait a minute, if ARK can get a big allocation to these IPOs, maybe we can benefit by anticipating which ones they will get and choose to participate in. So they've been doing that. We're seeing that, but it does take a bit of guesswork, and we don't participate in every IPO. So I don't think, I think that they'll probably be a little more judicious in doing this going forward, because I think some of this trading has caught them out flat-footed.
Yeah, that's a good point there, that it does take some guesswork. You want to be right when you're moving this amount of money, but help me when it comes to the structure of this and how much say ARK has. When you see a big trade like this coming through, is ARK in a position where it can reject the trade from the authorized participant?
No, we can't. We just, one of the most wonderful things about ETFs as a portfolio manager is I don't have to worry about flows. With mutual funds, the portfolio manager has to worry about flows. But the market around us, facilitating ETFs, market makers, authorized participants, It's fantastic. They handle all of the flows.
I see.
They're using all kinds of instruments, and we don't have to worry about it. So, I don't bother about it. We think a lot of good things are happening from a policy backdrop and therefore ultimately a macro backdrop. The deregulation that we're seeing is stunning. It started with crypto and AI. We have a crypto and AI czar now. And I think what many people have not paid enough attention to, mostly because tariffs have been getting all the headlines, given how chaotic they seem. But in OB3, so the one big beautiful bill, there was a tax policy measure that we're not sure has been integrated into many forecasts yet. And it has to do with depreciation, moving from depreciation to full expensing of structures. That has never happened before. Manufacturing structures for the next 3 years, in the first year they go into service, they will be able to expense fully in that year, as well as equipment, domestic R&D, and software. So music to innovation's ears, I would say. I think we're going to have a boom in economic activity. That first one, the manufacturing structures, is just for 3 years. The other ones have been made permanent. And so this takes our effective corporate tax rate in the United States, not statutory, that's still at 21, but the effective tax rate for the next 3 years at least is going to be roughly 10%, one of the lowest in the world. So I think we're in for some very good times. We think we're moving from a rolling recession into a recovery and then into a productivity-driven boom in activity.
Cathie also explained why ARK has avoided Ether ETFs for now. They can't stake, which means they miss out on a key part of Ethereum's value proposition. Instead, ARK has chosen investments like Bitmine, Immersion, and Soulmate, giving them exposure to ETH and Solana's ecosystem.
If you look at our performance in 2017 and 18, so when interest rate fears were rising and then interest rates rose, our portfolio outperformed in both years significantly. And 2018 was a down year. We were up. So I know that COVID, the boom bust around that time period, got a lot of people thinking, okay, inversely correlated to interest rate. Historically, that has not been the case. So just wanted to make that comment. In terms of the Fed, we do think interest rates will continue to come down. But if we're right, in 2026, at some point, it will be clear we're moving into a productivity-driven boom. What does that mean? Productivity is one of the most potent anti-inflationary forces. This is Reaganomics. It's deja vu. And you'll see back then in the 20 years that ended in the tech and telecom bubble, real growth was very strong. And during those moments in time, inflation came down to surprisingly low levels. And we think that's going to be true next year as well. In fact, we would not be surprised to see inflation well below 2% next year.
Cathie, with that said, I think a lot of people are slightly worried about inflation, but really just, interested in a hedge. I showed in the flows that every week this year, it seems like gold has been in the weekly flows in the leaders. GLD in particular is on its way to a record year, and even IAU is in the top 7. I mean, there's just so much gold buying along with this sort of rosy economic and stock market picture. Why do you think people are buying so much gold? What's your take on that?
Well, I do think there's been a lot of uncertainty, geopolitical uncertainty especially. So it seems as though there is a barbell strategy going on here, which is equities to take advantage of lower interest rates and potentially the economic environment that I just mentioned. And then gold, just as a hedge, it seems to me. And the same has been true of crypto assets. They are much more volatile than gold, but they have also done well over time. So I think this really is a barbell strategy.
I do want to talk about crypto. You think about gold transitioning into crypto. For a lot of people, that's digital gold. When it comes to some of the investments that you're making, Bloomberg News has reported that you could be one of the backers behind Tether, for example, in a major funding round. Is that correct? Is ARK backing Tether?
We can have no comment on that. So that's what I'll say there. I will say you'll see that we have backed DATs and Circle, so we're very well exposed to this crypto cycle. We think stablecoins generally, and of course Tether and Circle have 90% of the stablecoin market now. We think that is a very important entree. The holders of stablecoin will have an entree into the DeFi ecosystem, so decentralized financial services that will now take place on public blockchains. So we think that's really the definition of the next generation internet. It's the layer of the internet that was not built early on, because in the late 80s, early 90s, no one expected financial services to take place on the internet. So finally, 30 years later, we're getting the layer of the internet that is going to enable it.
So, Cathie, you mentioned DATs. ARKW has a big holding of Tom Lee's Bitmine and Brera Holdings, which is now Soulmate. I want to get your take on what you think of DATs versus ETFs. Why would DATs be a better way or a preferred way of investing as opposed to just in the coins themselves?
Yes, well, one of the reasons we did not choose to invest in one of the Ether ETFs is, at least as of now, they will not be allowed to stake. And we think staking for yield is a very important part of the Ethereum story. We were having a lot of trouble, therefore, getting access to Ether in our portfolio. So when Bitmine immersion came along, we thought that would be a great opportunity after it sold off significantly following the burst. We did take our position. And same with Soulmate. We have a lesser exposure to Solana, but we now have exposure to the big three: Bitcoin, Ether, and Solana. And we think all three are going to play an important role.
I would like to just come back to what Scarlett just asked, because I do wonder this. Let's just go to the Bitcoin DATs, right? There's so many that have popped up since strategy and since the ETFs were launched. Why on earth would you buy a DAT over an ETF at 20 basis points?
Well,
Why stablecoins? Because they're the gateway to DeFi and the next generation of the internet. With Tether and Circle controlling about 90% of the stablecoin market, Cathie believes they're building the missing financial services layer of the internet, something that was never envisioned back in the 80s and 90s. Now, 30 years later, blockchain is making it possible.